Everyone, this is Ryan Chen here with Loan Killer. In this video, I'm going to go over what debt structure is the right one for your business. And what if I told you the interest rate on your business loans really matters? I know that sounds wrong, but after reviewing over 3,000 loan files, the business is paying $40,000, $50,000, $60,000 a month in debt service almost never get there because of a bad rate. They got there because the structure of your debt was wrong. So today I'm going to walk you through the 5 factors that determine what debt structure fits your business, the math behind why the wrong structure can 10 times your monthly payment, and the framework that brings it back down without reducing your borrowing power by a single dollar. By the end of this video, you will walk into your next lending conversation knowing exactly what your debt should cost, how it should be layered, and which options the person across the desk is not showing you. Let's get into it. Now, I broke down the 8 types of business loans in a previous video, and I will link that above if you want the full breakdown to each one. But for this video, there's only one key concept you need to understand in order to figure out what the right type of debt structure looks like for your business. And that is every dollar you borrow has 3 cost drivers. The rate, which is what the lender charges you for the money, the term, or how long you have it to pay it back, and then the repayment structure, meaning how those payments actually hit your account. Most business owners fixate on the rate, but the term and the repayment structure often matters more than the rate itself, because $250,000 through an SBA loan at 9.75% over 10 years is roughly $3,270 a month, but $250,000 through a merchant cash advance at a 1.35 factor rate paid back over 10 months is $33,750 a month. The SBA loan has a higher number on the rate. The monthly cost is 10 times lower because the term is 10 times longer, and the payments are monthly instead of daily. That is what I mean when I say the structure of the debt matters more than the number on the term sheet. And the structure that fits your business comes down to 5 factors. And if you get these right, you are going to borrow at 7 to 12% with fixed monthly payments and 10 to 25 years terms. But if you get them wrong, you are paying 40 to 150% effective APR with daily debits hitting your operating accounts. Now, the first factor is your cash flow profile. The way money moves through your business determines which loan products are even available to you. If your revenue is steady and predictable, think recurring contract, long-term clients, consistent monthly sales, you qualify for the cheapest capital available. Things like bank term loans, SBA, and conventional real estate financing. Lenders love predictability because it means the monthly payment is easy to service. But if your cash flow is seasonal, construction, landscaping, retail, a fixed monthly payment can crush you in the slow months, even if the annual months works fine. In that case, a revolving line of credit is much better because you only draw when you need it and you only pay interest on what you use. So a $200,000 line at 10% where you draw $80,000 for 3 months costs you about $2,000 in interest. Compare that to a $200,000 term loan at the same rate where you're paying $4,250 a month, whether you need all the capital or not. Now, the second factor is your asset base, and this one determines how cheaply you can borrow. If you own real estate, heavy equipment, large receivables, or significant inventory, you have collateral. And collateral is the single biggest unlock in lending because it reduces lender risk, which directly reduces your rate. A business HELOC against your home's equity starts around 7.5%. The DSCR loan against income-producing commercial property can go even lower, around 6 to 7%. And equipment financing, where the equipment itself backed the deals, runs 13% plus. Now, if you have assets like these and you are borrowing against your future revenue through an MCA instead of leveraging the collateral you already own, you are almost certainly overpaying. I see this constantly. A business owner with $200,000 in home equity and the $720 credit taking a merchant cash advance at a 1.4 factor rate because nobody showed them the HELOC option. The HELOC option costs $7,500 a year on $100,000. The MCA costs $40,000 in fees over 8 months on the same amount. That's 12 times the cost just because the right product was never on the table. The third factor is where your business is in its life cycle. If you are in your first 2 years, your options are limited. Most banks will not touch you, and SBA is difficult without a track record. Your best bet at this stage are equipment financing, when equipment itself is the collateral, microloans, and personal assets like a HELOC if you have the equity. Once you hit 2 to 5 years or $500,000 or more annual revenue, the landscape opens up significantly. SBA becomes realistic, banks start to take your calls, and business lines of credit becomes available. After 5 years of clean financials, you have access to the full menu. The mistake I see at every stage is business owners reaching for products that do not match where they are. A startup taking an MCA because it is the only thing that will approve them fast, and then getting trapped in daily debit business before they ever build a track record they need for cheaper capital. Bear in mind, the cost of borrowing your early years sets the trajectory for everything that comes after. The fourth factor is your existing debt load, and this is the one that trips up the most business owners I work with. Your debt service coverage ratio, or DSCR, measures how much cash your business generates relative to what you own every month. Lenders want to see at least 1.25x, meaning for every dollar of debt payments, your business needs to generate at least $1.25 in net operating income. And what most people miss is that every existing loan you carry eats into that ratio. So if you already have merchant cash advances with 1,500 or 2,000 a day in combined ACH debits, your DSCR might already be below 1.0. And at that point, not a single lender offering reasonable terms is going to prove you for anything new. You are locked into expensive capital because the expensive capital you already have is killing the ratio you need to escape it. But the math works in reverse too. If you can refinance those MCAs into longer-term lower rate products, your monthly debt service drops, your DSCR improves, and suddenly you qualify for even cheaper capital on the next deal. That compounding effect is the whole game, and it is why getting the structure right matters more than almost anything else on your balance sheet. The fifth factor is your time horizon, and this one is more expensive than most business owners realize. Because the faster you need money, the more it costs. An SBA loan at 9.75% takes 60 to 90 days, while a cash advance at 80 to 150% effective APR takes just about 24 hours. That urgency premiums is enormous. A business that plans its capital needs 90 days ahead saves 20 to 70% points in effective APR compared to the one that needs money by Friday. So the single best thing you can do for your cost of capital is to stop being reactive. If you know you're going to need expansion capital, equipment, working capital, or refinance in the next few months, start that conversation now. Every week of lead time is money back in your net operating account. Now, these 5 factors are the lens I use every single day when a business owner comes to me and say they need capital. And if you want us to run that same analysis on your situation, there's a link in the description where you can fill out an application, and our team will break down exactly what product fits your business and what your cheapest path to capital looks like. So, these 5 factors tells you what product belongs in your capital structure, but knowing which one fits is only half the equation. The real difference between that 4,600 a month number and that 42,000 a month number comes down to how you layer them together. The combination of the capital sources in your business is called a capital stack, and the way you build that stack determines your total monthly debt service, your cash flow flexibility, and whether your business is growing or just servicing debt. So if you have an HVAC company doing about $5 million a year, you have a commercial building, equipment on the books, and a home with equity in it, under bad capital structure, the number will look something like this. The commercial mortgage on that building is running 8.5%, about $5,850 a month. On top of that, 2-stack cash advances totaling $200,000 at a 1.35 factor rate are pulling $27,500 a month in daily ACH debits, and the equipment is financed through an online lender at 22%, another $8,500 a month. And all of that up, total monthly debt service hits $41,850. Now, if you restructure that same capital without changing anything about that business, here is what happens. The commercial building goes on SBA 504 with 10% down, and a fixed rate around 6% on the SBA portion, which drops the monthly payments to $4,500. The equipment gets refinanced through a bank lender at 7.5%, bringing that down to $6,015 a month. And the MCAs get eliminated entirely, replaced by a business HELOC on the owner's home at 7.5%, sits there as a revolving facility and costs nothing when it's not used, plus a $150,000 line of credit prime, plus 2 for working capital gaps. Add all of that up, and total monthly debt service drops to $10,515, which means $31,335 a month is going back into the operating account instead of debt service. That is $376,000 a year back in the business, and nothing about the underlying company change. And the principles behind that restructuring are straightforward. Long-term assets gets long-term debt, so a building should be on a 20 to 25 year term, and equipment gets matched to its useful life, meaning a truck fleet goes on to 5 to 7 year notes instead of a 10-month MCA. Working capital is different because the need fluctuates, so that belongs on a revolving facility where you only pay interest on what you actually use. And the cheapest available capital always get deployed first. Every dollar SBA, conventional bank, and HELOC capacity should be used before you touch alternative lending, because the rate spread between an SBA loan at 9.75% and an MCA at 80% effective APR is over 70% points on the same dollar. When you apply those principles across every line item on your balance sheet, the numbers change dramatically. Now, that 42,000 structure does not happen overnight. It builds. It starts when a business hits a cash flow gap, needs money, and takes an MCA because it is the only thing that can fund in 24 hours. The daily ACH starts eating an operating account. 3 months later, they take a second advance to cover the shortfalls the first one created, and now there are 2 daily debits running simultaneously. I have seen 3 stack advances of 225,000 in total capital created, combined daily ACH of 1,500 to 2,000 a day, which is over 40,000 a month going to debt service. At that point, 30 to 40% of incoming revenue is being redirected before you can even pay a vendor or make payroll. And each additional advance drops your DSCR further, which disqualifies you from the conventional product that could actually fix the problem, which pushes you back toward the same expensive lenders that created it. That is the cycle, but the path of it follows the same roadmap almost every time. First, you get clear on where you actually stand. Every existing debt with its balance, rate, and payment schedule laid out in one page so you can see the full picture. Then you can calculate your current DSCR. Once you know those numbers, the next move is to stop the bleeding. So no new MCAs. If you have home equity, a HELOC gets deployed to pay off the highest cost position first, because that single move can take your interest from 80% effective APR down to 7.5% overnight. If you do not have home equity, you focus on paying down the stack in orders of lowest balance while keeping the business running. Either way, the goal is to get daily ACH debits off your operating account. As those expensive position clears, your DSCR starts improving. And once it crosses that 1.25 threshold, conventional lending markets opened up. The SBA becomes realistic, lengths of lines of credit becomes available, and equipment financing becomes at institutional rates instead of online lender rates. Each product you move into at a lower rate frees up more cash flow, which improves your DSCR further, which qualifies you for even better terms on the next deal. And that compounds in your favor the same way stacking MCA compounds against you. A business carrying 300,000 in stacked MCAs at an average 1.38 factor rate is paying roughly 42,000 a month in debt service. Your DSCR is sitting at 0.85, which means no conventional lenders will touch them. After 18 months of restructuring that same capital into an SBA loan at 5.75%, a business line of credit and equipment financing at bank rates, total monthly debt service drops to 4,600. After 18 months of restructuring that same capital into an SBA loan at 9.75%, a business line of credit and equipment financing at bank rates, total monthly debt service dropped to $4,647, and DSCR jumps to 1.62. That is $37,000 a month back in the business, $448,000 a year, and the only thing that changed is how the debt was structured. And that is exactly why I tell every business owner I work with to stop asking which loan they should get and start asking what your optimal capital structure looks like. Because the answer is different for every business. Things like cash flow, assets, growth stage, existing debt, timeline, all interact differently depending on your specific situation. Mapping that out and engineering the right combination is what we do at LoanCare every single day. We have funded over 1,000 loans. We work with 50+ institutional lending partners, and we carry a 60% approval rate across all our application base. And if you want us to look at your full picture and build a capital structure that fits where you are right now, I'll leave a link in the description where you can fill out an application. Our team of experts will break down exactly what you qualify for, what the rates look like, what your total monthly debt service would be in an optimized structure compared to what you're paying right now. So go below, fill in that form, and I'll see you there.